All right, let's dive into the first question, final exam review question number 1. This is a review from chapter 7. So if this is a chapter that you do struggle with, I highly encourage you to go back to chapter 7 videos and redo them. Very important. Remember, the more you practice, the higher chances you have of getting a high mark in this class. So this company is a merchandising business that sells to retail stores all over Canada. This is the 4th year of operations, and due to the rapid expansion, Olive is concerned about her accounts receivable balance at year end. In order to grow the business, all customers have been offered credit terms 3, 10, and 45. Once again, if you pay within 10 days, you get a 3% discount. So the customers, in this case, the customers have to pay within 45 days, net 45, no matter what, which Olive believes results in faster payment of the outstanding accounts receivable. So she's offering a higher credit. She's offering a higher percentage. Remember, we've been seeing 1% and 2%, but she's offering a higher percentage just to induce faster payment. She also believes that it creates higher sales because her business is offering such favorable good credit terms. I just explained that. At December 31st, 2016, the current year end, Olive has the following information about the activities during year 2016. I'm going to come back to these transactions in a bit. Let's just keep reading forward for now. So essentially, do all the required entries for 2016 except the estimate for the uncollectible accounts. The chart is provided for you. Note you have been provided with the account names, but you will not be provided with account names for the final exam. That is very important, right? Very important. So let's dive right into it. We're given opening balances. The opening balance for accounts receivable is 133,000, 133,000, and the opening balance for allowance for doubtful account is negative 15,960. Remember, this is negative because allowance for doubtful account is a contra asset account. Once again, a contra account is attached to a principal account and it reduces it. So accounts receivable of 133,000 plus negative 15,960 gives us our net receivable. So when this account is negative, it increases. Opposite effect. Then they're saying that total gross credit sales during 2016 were 984,750. So simply put, we are going to increase. Remember, it's credit sales. That means accounts receivable 984,750. Accounts receivable is going to increase by this amount, and by the same token, sales revenue is also going to increase by the exact same amount. Then cost of goods sold during 2016 were 541,620. So in this case, inventory is going to decrease by this amount, 541,620. By the same token, cost of goods sold is going to increase by 541,620. So this transaction over here, remember, whenever we have a sale, it's a two-part entry. We have to update the revenue, and then we have to update the expense. So this is a review from the earlier chapters, the merchandising chapter, right? Because remember what I said, everything in accounting connects. All the chapters do connect in a way. Then the next transaction is we have a write-off now. So a write-off of 18,460. So over here, it says that do not record the estimate for uncollectible accounts. Remember, that's an estimate that we do at the end of the year. And we do that based off of the total AR balance or the aging of the accounts receivable. So we'll talk about that in a bit. But now we know for certain that we're not going to receive this money because the customer came to us and, guys, I went bankrupt. I can't pay you guys. Simple as that. So this is with certainty. So to write it off, we're going to reduce our accounts receivable balance by 18,460. And by the same token, we're going to reduce our allowance for a doubtful account. Remember, since this has original negative balance, to reduce it where it's going to be positive 18,460. So that's how we're going to record the write-off. Okay, now we had a sales return. So we had a sales return. So the sales value, remember, whenever we're selling a product, it's a two-part entry. Whenever we have a return, it's also a two-part entry as well. So first, we're going to reverse the revenue part, but the reversal is going to go into sales returns and allowances. So remember, this is a contra account, so it's going to be negative 17,200. And by the same token, since they returned this value, they don't owe us this money no more. So we're going to reduce accounts receivable as well by 17,200. Now, the cost of goods sold portion is 9460. We're going to update that to our inventory because now we're returning the product back to our inventory since they returned it 9460. It's going to increase our inventory. By the same token, our cost of goods sold is going to be reduced by 9460 because we haven't sold those products yet, so it's gonna decrease our cost of goods sold. All right, now we have a sales discount of 17,085. This is a little bit tricky. So the discount is gonna go directly into this over here. So negative 17,085. So in this specific question, we have to scroll down a little bit. We're going to scroll down to the aging of AR because in the aging of AR, they're giving us the ending balance in accounts receivable. So 139,530, correct? Now we have to solve for the missing variable, right? To do that, we're going to first figure out what the current balance is. So we're going to do the 133,000 plus 984,750 plus negative 18,460 plus negative. Remember how I said negative? Make sure you do plus 7,200 and change it to a negative number. Same with the 18,460 to arrive at 1082090. Now to calculate the missing variable to get this down to this, we're going to simply do 1082090 subtracted by 139,530 to get negative 942,560, right? So that's how much AR is going to go down by. Then the total cash that we're actually going to spend is going to be the difference of these two, right? Because remember, even though we owe 942,560, we get 17,085 discount. So we're going to actually spend 942,560 minus 17,085 negative 925,475. Now we're going to calculate the ending balances in each account. I'm just going to type in a quick formula for this. I want you to do it manually and then just compare your answers to mine. Let's run this formula across now. Here we go. Perfect. Okay, now let's go back to the question. So we've done the first part. If Olive used the same 12% of total accounts receivable, what would her estimated uncollectible account be? Okay, so for the next part, what they're saying is we're going to take the total ending value of accounts receivable of 139,530, and we're going to multiply this by the estimated rate, which we said is 12%, to arrive at, remember, the ending balance allowance for doubtful accounts. So this gives us 16,743.60. So that will be the estimated uncollectible account. So that'll be the ending balance and allowance for a doubtful account of this much. Explain to Olive what the age of accounts receivable is and why might she want to use that method to estimate the uncollectible accounts receivable instead of the 12% of accounts receivable. That's simply because it is a more accurate method. Simple as that, right? Because the aging of AR splits up the total AR into different time periods, as you can see over here. what's due currently, 80,000, and the chances of that being uncollectible is 1%. Now, what's due within what's overdue within 1 to 30 days is 31,370, and that's 10%. Then what's overdue between 31 to 60 days is 15,440, that's 25%. Then what's overdue 61 days is 12,720, 65%. All these add together gives us a total AR balance, right? So it's just a more accurate method. And as you can see, the longer it's overdue, the higher chance that we're not going to collect it. So that being said, to calculate the ending balance using the aging of AR method, we're going to first calculate the 80,000 times it by 1% or 0.01. Then we're going to do 31,370 times 10% or 0.10. Then we're going to do 15,440 times 0.25. Then we're going to do 12,720 times 0.65. And now we're going to add all these together. 800 plus 31,370 plus 3860 plus 8268 to arrive at 16,065, right? And that's going to give us our new ending balance in AFDA. Calculate, so yeah, we've already done this, right? So calculate the ending balances for the chart after you make the entry for the estimated uncollectible accounts. So that entry, let's put it in over here. So the new balance has to be 16,065, right? And then remember to calculate the adjusting entry now, right? So let's update this right now. This adjusting entry is simply going to be, remember, so the current balance in AFDA is going to be negative 15,960 plus 18,460. So we have a positive number, which is fine, right? Positive number means that our initial estimate was much lower than we anticipated. The actual write-off was much higher. Then the new balance is going to be negative. Remember, this should be negative. Remember, allowance for doubtful account is a negative account. Negative 16,065. So simply put, negative 16,065 equals 2,500 plus question mark, right? To calculate question mark, we're going to do 2,500 plus 16,065. And this is going to give us a negative number, remember, because it reduces it, right? So this is going to give us negative 2,500 plus 16,065, which is negative 18,565. So our allowance for doubtful account is going to be negative 18,565 because this increases allowance for doubtful account. It increases the negative spike because it's a contra account. But our bad debt expense is going to be positive 18,565. Now they're saying to prepare the multiple step income statement down to the gross profit. So when we do this, we have a 3-part title. We have the company name. The company name, let's go up, is Alavita Inc. Then we have the multiple step income statement. And this is for the 4th year of operation. This is say December 31st, year 4. So we're going to start off with sales revenue first. So we know that sales revenue is going to be 984,750. Then remember, we're going to subtract sales returns and allowances. And then we're going to subtract sales discounts. So we know these values are going to be, so returns and allowances is negative 7,200. Then sales discount is going to be 17,085. And this gives us net sales now, correct? That net sales is simply going to be 9,84750 plus negative 17,200 plus negative 17,085. Then we're going to subtract cost of goods sold, which we also know, which is right over here, is 532,160. And this gives us our gross profit of this 950,465 minus 532,160. Yeah, so this wraps up for this question.